different regime compared to the last 4 decades, effectively.
So it's almost an easing bias in the market?
Pivot by Powell was just what's really driven the real change in unemployment markets, inflation markets this year. And that for me was the big changing point for me. That's when I became really bullish this year, and I remain very bullish. Now, the whole point of this article is that there's a risk that next week we suddenly get the hawkish surprise that derails things. And I guess that is a valuable point. And maybe next week will cause a painful kind of correction or pullback in stocks. It's important to emphasize, though, that any hawkish pivot from the Fed now will be in context that it's much stronger growth. It's for the best possible reasons. It's because the consumers continue to spend, the unemployment market staying strong, growth continues to be better than expected, and therefore that is the best reason for yields to go higher. So again, it'll likely be volatility rather than a major turning point.
Okay, to the extent to which that offsets concerns around the height of rates, that'll be really interesting to watch as we go through this year. Let's talk about Japan. Really interesting piece out from your team this morning, talking about, yeah, sure, speculators maybe short the yen, but that's not the whole market, and we need to keep that in mind as we look ahead to the BOJ and the possibility of intervention.
Yeah, look, the yen market is not short. There's not a net short there. CFTC speculators are short the yen, but they are mainly CTAs. They're momentum traders, and they're a small subset of the market. Discretionary traders are largely staying away because of the risk reward. Now, after this BOJ, people are going to want to sell the yen again. Now, they're hoping they're going to get to sell the yen after there's maybe been a hawkish surprise from the BOJ, or maybe even intervention. But intervention from the MOF will not start a yen rally. If anything, it'll just provide better levels to resell the yen again.
It's interesting that we're talking about that yen move, which is really coming off a pop of the dollar, which again is related more to the yield picture that you're seeing in the States than anything else. Mark, don't go anywhere. I want to bring in a chart that caught my eye, which is kind of related to all of this. I'm nerding out a little bit from my M Live days and talking about this 2-year auction that we saw yesterday. Now, this is important and it gets a little wonky, so stick with me here. We're looking at the indirect takedown of that 2-year auction. And here's why I paid attention to this one in particular. Shout out to Cameron Kreis over in the States for pointing this out. You are seeing the biggest indirect bid for the 2-year going all the way back to June of last year. And that's what this kind of chart really shows. That blue line is what we saw yesterday. That yellow line is that kind of high that we've seen historically. Of course, this is a 5-year chart. The reason I bring this up, Mark, is simply because at least Cameron Kreis's take was the closer and closer you get to that 5% level, the market will still take down. There will still be a bid for the front end of the curve, even though cuts are priced out to 2025. What do you make of that demand that really nobody saw coming?
Yeah, I think that's right. I think that there is a kind of a structural shift to just collect higher yield in your portfolios when these bigger yields are on offer. And that's why, even though we're moving to a narrative of higher yields and then we're getting this suddenly going from a world where we are pricing more than 6 cuts at the start of the year to we might soon be talking about hikes again more seriously as the next move. Therefore, we've got more to move in yields overall. It's not becoming a dysfunctional move. It's not becoming a broken market. It's a structural, an orderly sell-off of the treasury market because it's selling into structural long-term demand. And I think that'll remain the case even as yields continue to go higher.
Mark, let's talk about yields going higher and come back to the Anna Wong piece. Does the Fed need to get financial conditions tighter? And is the way that it needs to get financial conditions tighter by cracking the stock market?
It's a great question. So I think the first part of the question, financial conditions are essentially how the Fed can control the economy. It's not actually monetary policy. Monetary policy works via financial conditions, but Simon Flint, our colleague, has done an excellent analysis showing that it is really financial conditions that have the power here, not monetary policy itself. And in fact, one of the problems of recent decades is that monetary policy's impact on financial conditions has declined as the share of stocks and credit wealth in consumer portfolio has grown. So that's one issue we've got there. That probably leads into your second point. If they're going to get financial conditions tighter, they either need much tighter monetary policy because all these people are on long-term mortgages, because the power of monetary policy has shrunk since over the last 20, 30 years, and the equity power has grown, or they need to crack the stocks market. I guess what I'm saying is they don't have to crack the stock market. But if they don't crack the stock market, they're going to need to raise rates a chunk higher still. Either way, there's more that needs to be done from the Fed in some manner.
We live in interesting times. Mark, it looks like this year is going to prove an interesting one in the second half. We'll see what we get coming up and whether Anna Wong's call on this next FOMC meeting is going to be prescient. Our Markets Live executive editor, Mark Cudmore, thank you very much indeed. You want to get the themes, the ideas, and Mark mentioned plenty of them there that are coming on the MLive blog. MLive Go is the function on the Bloomberg terminal. Let's turn from the macro to the micro. Let's figure out what's happening with some of these single stocks. Joe Easton, what do we got?
Morning, guys. So we're starting with Kering, and the French luxury firm is set for a big drop at the open today as it warns of a slowdown across its business, particularly over in Gucci. We saw the ADRs for that stock falling almost 9% in US trading once this report hit. And we're going to bring up a quote from the CEO, which really summed up what's going on. The firm warning that while they already had anticipated a challenging start to the year, sluggish conditions, particularly in China, have continued, and that has exacerbated the downward pressure on the top line, particularly at Gucci. But it's not just Gucci. They've seen sales declines across the other brands as well, including Yves Saint Laurent, a 6% drop there. Obviously, Gucci down 8%, really the big number that stands out. The only real strong point was Bottega Veneta, that was up very slightly, and also iCare. But the other houses as well, this includes Balenciaga, down as well, down around 6%. So big drops across most of the main units for Kering today. And looking at a one-year chart, we can see that stock already slumping. It's down around 40% over the past year. It's underperforming LVMH and Hermes. The issue is they're not offering enough on the high-end defensive area, and also the aspirational buyers at the lower end not as excited with the new Gucci products not yet coming fully onto store. So that one could be a rough one today. Then we're also going to look at the Swiss pharmaceutical giant Roche. This company has a $200 billion market cap, and they are reporting a pretty significant decline in sales in the last quarter, down 6% to around 14 billion Swiss franc. They are still impacted by the decline in COVID-related products, so testing, that kind of thing. But they say this is the last quarter that they will see that impact. But also some of their oncology drugs over in the cancer space not doing as well either. If we look on the 5-year chart, here's the decline from the COVID peak, a big drop down there, and a number of analysts still sell rated on the stock, including big names like JPM, Morgan Stanley, Deutsche Bank, all of them predicting more downside, and potentially this feeds into that idea today. Then we're going to finally look at UK banks. Lloyds kicking us off with a number of reports coming out this week. It's not a great start. Lending income at Lloyds is suffering. This continues a theme of people switching their banks into higher paying accounts. Net interest income missing quite significantly. The mortgage market remains weak, of course, and the net interest margin down 27 basis points to less than 3%. We've got reports from Barclays coming out tomorrow, NatWest on Friday. This kicks us off. Not a great start. Lloyds could be weaker today.
OK, thanks very much, Joe. Our equities reporter, Joe Easton there. And on the subject of Lloyds CFO on the call with analysts now saying that they expect the margin pressure to ease through 2024, which will be something really interesting to watch how that develops through 24, because expectations are on the move with regards to how many cuts we get from the Bank of England, and therefore what kind of assumptions a business like Lloyds can be making.
I think Hugh Hill was on the tape yesterday.
Yeah, pretty hawkish.
Sounding, really quite hawkish. And you do feel like the balance on the MPC may be starting to shift in that direction in a fairly substantial way. In terms of what else, keep an eye on Boeing later. Boeing's going to be really interesting. In terms of what they're going to tell us. Obviously, we've seen some significant scandals around that business. The CEO is going to be departing. A lot of the senior management team are going to be departing. What are they going to tell us today? I'm going to ask that question in a few minutes' time to MOL, Michael O'Leary, who has a news conference in London today, the details of which I'm not going to give you, but I am going to ask him about Boeing, because they are waiting for their 737 MAXs, and that is going to impact their summer season in quite a significant way, the delays that we're seeing there. Who would he like to see as the new CEO of Boeing?
Does he go by MOL? Or
Everybody,
just you?
kind of internally.
That's how Guy knows him.
If you're part of the loop, you get to call him MOL. Is that it?
I've known him for a long time. Yeah, I think it's Michael O'Leary is quite a long thing to write out in an email, so I think a lot of people just kind of write it down as MOL.
Fair enough.
There's a lot of companies to watch at the open then, Critty. Guy's off to do his thing around aviation. We'll be keeping an eye on Lloyds Banking Group, Heineken, Volvo Cars could be on the move. But overwhelmingly in Paris, we'll keep an eye on the luxury sector.
Yeah, it's the Kering story that's fascinating. I think on TradeGate, it's almost 8% decline that is indicated. And we're seeing that show up in perhaps futures as well, with the French index underweight there as well. We're going to dive into all that coming up on the Market Open. Stick with us. This is Bloomberg.